Okay, so these are going to be questions on this one. We pretty much did chapter 17 and 18 last time, and so this is the questions for chapter, I took these from chapter 11, 12, 21, and 22. Okay, so our Chapter 11 was mainly our passive activity loss discussion. Chapter 12, payments and credits. Chapter 21, partnerships. Chapter 22, S corporations. And we did 16 and 17 last time. And as I said last time, you know, these chapters are going to be fairly light on the exam. Okay, so I'll maybe take, you know, one or two from each chapter. Most of the questions coming from 17 and 18. And then I'd say maybe, I don't know, maybe 4 questions out of the 20 from past exams. So it'll be the exact question that was on the past exams just to make it a final, make it a comprehensive final. Okay, all right, so let's go ahead and let's take a look at these. Miguel contributes land to a partnership with a basis of $12,000. Fair market value is $18,000. How much gain should Miguel realize? That's just sort of to get you started here. Remember, when we start the partnership, we bring everything in at the partner's basis, and there's no gain in the partner's basis in the share of the corporation becomes whatever the basis was in the property that they contributed, right? Okay. Number 2, Bethany contributes a building to a partnership with a basis of $12,000 and a fair market value of $200,000. Bethany's basis in her partnership is going to be whatever her basis in the property was that she contributed. So they basically, you can see through those two questions, the partnership and the partner exchange basis, right? Number 3, Raul contributes the following assets to a partnership for 50% interest. What is Raul's basis in the partnership? And it essentially whatever the basis was in the assets that he contributed. So nothing surprising there, right? Okay, number 4, Tim, Al, and Pat contribute assets to form the equal Tim, Al, and Pat TAP partnership. Tim contributed cash of $40,000 and land with a basis of $80,000, fair market value of $60,000. Al contributed cash of $60,000 and land with a basis of $50,000, fair market value $40,000. Pat contributed cash of $60,000 and a fully depreciated piece of property with a basis of $0, valued at $40,000. What is which of the following tax treatment is not correct? And I seem to be missing the nots sometimes when we come through these questions, and I should know better after all these years of teaching CPA exam to read the question carefully and catch your knots, okay? But which of these is not correct? Tim's basis in the partnership interest is $120,000. Well, he contributed what? Cash of $40,000 and land with the basis of $80,000. Yes, he will take his basis in the partnership based on the basis of the assets that he contributed. Al realized and recognizes a gain, a loss of $10,000. That statement is what? Is not correct because what? He does not take the loss. He is going to just have what? The basis in the property be what his basis was, which was what? 50, and he's not going to be able to take that 40 loss. Now, if he wants to sell the stock later, or the partnership sells the stock, then they'll take the loss at that time, right? But not at the time that he contributes it. Okay, Pat realizes a gain of 40, but recognizes 0 gain, and that's one of those annoying realizes versus recognize. Recognize meaning what? That he's not going to have to pay tax on that, right? There's no gain. There's no taxable gain. TAP has that's correct. You don't have to recognize a gain because he's contributing the property, right? TAP has a basis of 80, 50, and 0 in the land, respectively. That's obviously correct, and that the partnership takes over the basis of the property from the partners when they contribute it, right? Okay. All right. Not too bad. Number 5, a guaranteed payment is treated as both a separately stated item and an ordinary expense. Now be careful with this, guys, and we're going to get some practice with this here in a minute. There's a difference between a guaranteed payment and what? And a distribution, right? Okay, distribution is not considered a deduction to the partnership, whereas a guaranteed payment is considered a deduction for the corporation, and of course it is also going to be considered what? Income to the partner. So it is considered both a partnership deduction and a what? Separately reported item, right? Okay. Just remember, let me see if I can find it. What chapter was that? 21? Oops, not that one. I don't want that. I want the slides for 21. I'm probably going to have to hit every icon on my computer until I find it, but and then you'll be like, okay, who cares, right? But where is chapter 21 slides? I think somewhere we had the 1120 in here, didn't we? I mean yeah. Okay, so when we're looking at how we're preparing, notice we have somewhere on here gross receipts, return of allowances, cost of goods sold. Here it is, item 10, guaranteed payments, $240,000. They're considering that sort of like a salary that they're paying the partners for their involvement. So that is a deduction from in calculating the ordinary income for the partnership. Now, when you get over here, okay, when you go to the next slide right here, okay, and did I go to the next slide? Yeah. When you come over to the next slide, they keep going with that calculation, but then when you get to where they start reporting to the partners have what? The report of their guaranteed income as well. Okay, so it's also a separately, it's guaranteed payments, it's also a separately calculated item. Where is that? See how, there it is. See when we get to their K1, guaranteed payments is also listed there. Okay, so that's what that question is telling us, is it's a deduction from the standpoint of the partnership on the 1065, but it's also reported as income to the partner on their K1. Now, distribution to the partner is not going to be taxable, as is not the what? It's not going to be deductible to the to the partnership. Okay. All right, so you take a look, DPL, guaranteed payment is treated as what? Both a separately stated item and as an ordinary expense, right? Okay, it meets both criteria. It's reported as both. Number 6, DIP LLC reports ordinary income before guaranteed payments of $120,000. And we have what? Rent expense here of $40,000, interest income of $4,000 for the year. In addition, DIP paid programming payments to DIP paid guaranteed. I don't know where I got programming payments. DIP paid guaranteed payments to partner Percy of $20,000. If Percy owns 40% capital and profits interest, how much income will he report for the year, and what is its character? Okay, so you take a look and notice that, let's deal with the easy ones. We see the answer is B. He's reporting what? He's reporting the guaranteed payment of 20. He's reporting the guaranteed payment of 20. Where am I? B. Okay. That's going to be on his K1. And then his share of the interest. Okay. So he has interest and he's a 40% owner, so he's going to get that. So then we just have to figure out where they got this ordinary income number, and notice we pick up the 120,000 income less the rent. That's obviously an expense. And we also do what? Subtract that guaranteed payment as an expense as well, right? So then we're left with whatever that comes out to, 120 minus 40, what's that, 60,000? 60,000, but since he owns 40% of that, he gets 24,000, right? Reported as his part of his ordinary income. Okay. Okay, good. Number 7, which of the following would be currently taxable as ordinary income to the service partner if received in exchange for services performed for the partnership? In all cases, assume the interest is not sold within 2 years after the time it is granted to the service partner. And you could choke yourself off with minutia here, but the key thing is what? If it's something that it's questionable as to whether they'll get the value out of that, then it is not taxable as current in the current period, right? If it's just based on the work that they provided, then that is going to be taxable, right, in the current period, and they get a profit interest in that. So a capital interest in that, I should say. So a 10% interest in the capital of the partner that will vest in 3 years. Who knows, right? There may not be any value there in 3 years. Okay, so that's not correct. A 20% interest in what? Future profits. Do we know we're going to have future profits? We do not, so we can't use that. A 25% interest in the capital of the partnership where there is no restriction on transferability of the interest. No restrictions, got something of value, 25% of the capital of the corporation, and so we would go ahead and count that as that would be taxable. Okay, and it's obviously not all of the above. Okay, so again, if there's something that's yet to happen, and I think in the slides we just talked about it in terms of entitle you to future income or something, and these were sort of falling in that same ballpark of something has to happen, there has to be profit in the future, etc. If it's on a what's the word there, uncertain event, then we don't take it. If it's on something that's already occurred, we've done the work, there's already value there, then we can take that. Okay. Number 8, we'll have to declare that as income. Number 8, Christy is a 30% partner in KMM, and KKM, I should say, partnership. During the current year, KKM reported gross receipts of $280,000, charitable contributions of $30,000. The partnership paid office expenses of $80,000. In addition, KMM distributed $60,000 to partners Kaylin and Megan, and the partnership paid Kaylin $20,000 for administrative service. Christy reports the following from KKM. So they want to know what Christy's going to get. Now they tell us that the corporation, not the corporation, but the partnership made what, $280,000? Okay, but then we got to figure out if there's any things that we can deduct here as non-separable items, right? And so the charitable contribution, $30,000, that's not non-separable. That will be given to each partner, right? Okay, to do whatever they're going to do with it on their individual return. The partnership paid office expenses of $80,000. Is that a legitimate expense? So we take that $80,000. In addition, KMM distributed $20,000 to each partner. Those are not deductible, right? They're just considered drawings by the owners. But what about this $20,000 to partner Kaylin? Because they're paying her for some sort of, I guess, administrative services here or something, we go ahead and we subtract out that $20,000. And so that's going to give us here left, what, 180? Am I doing my math right? 180, and of that, the Christy, the person they're asking us about here, has 30% of that, right? So 180 times 30% means that we've got, what, 54,000 here? Okay, so we've got this 54,000, that's the ordinary, and then the part that is going to be a separable reported item that'll go to Christy is her share of the charitable contribution. That's 30,000 times her 30% share, obviously, is where the 9,000 is coming from. Okay. Okay, good. Let's take a look at number 9. And we got Molly is a 30% partner in the MAP partnership. During the current tax year, the partnership reported ordinary income of $200,000 before any guaranteed payments and distribution to the partners. The partnership made ordinary cash distribution of $200,000 to Molly. I don't know why they had to put the ordinary in front of $20,000. I don't know why they put ordinary on there just to screw you up. I don't even know what an ordinary distribution is. Okay, but other than to make you think it's somehow part of the answer here, I guess. And paid guaranteed payments to partner Molly, Amber, and Pat of $20,000 each. So that's 60 total guaranteed payments. How much adjusted gross income is Molly's adjusted gross income as a result of this? So we've got what? We've got the 200,000 that they made minus what? 20,000 each. So that's 60,000, right? For a total of what? 140 is the ordinary income of the corporation, of which she gets how much? She gets 0.3 of that, so that's going to give us 42,000. Okay, so her adjusted gross income as a result of this is going to be this 42,000. Okay. Okay. Of her guaranteed payment, I think because they're asking, they didn't ask her taxable income, they're asking the adjusted gross income. Who asked me that question? It's because they're asking the adjusted gross income, so that guaranteed payment is going to come in as on, I think, on her 1040 and not below the line, not as adjusted gross income.
The cash, the distribution. The answer is C.
Oh, okay, you're right. I'm sorry. Yeah, the answer is C. You're right. So it's the right. It'd be the cash that she would receive, but the guaranteed payment would be added in the 20,000. Yeah. Thank you. Okay. So you got to add the guaranteed payment to get her AGI. Okay. Okay. Good. Number 10. Stephanie is a calendar year cash basis taxpayer. She owns a 50% profit and loss interest in cash basis partnership with a September 30th year end. The partnership's operating income after deducting guaranteed payments was $120,000. That was $10,000 per month times 12. And what, $144,000 in year 2, $12,000 per month times the 12 months, obviously. For the partnership tax years ended September 30, 2016, 2017, the partnership paid guaranteed payments to Stephanie of $2,000 and $3,000 a month for the 2 years, 2016, 2017. How much is Stephanie's adjusted gross income will be increased by these partnership items for tax year December 31st, 2016. So first off, we got to get the right year because they give us a whole bunch of years in there. So we've got 2016, and then we've got what? For 2016, they were paying her $10,000 a month, so that was $120,000. But and she gets what? She gets 50% of that? Okay, so 0.5 times 0.5 is going to give her 60,000. And then she got what? She also had guaranteed payments of 2,000. So she got these guaranteed payments of 2,000 times 12, which means she got what? 24,000 there. Okay. So you take the guaranteed payment plus her share of the income gives her this 84,000. Okay, now that one's a little tricky because they give you this parenthetical after deducting the guaranteed payments, where other times they made us deduct the guaranteed payments. So sometimes the questions will deduct it for you, sometimes they won't. Okay, all right, good. Number 11, if a corporation, so we're done with partnerships, okay, questions. We got about 10 of those. We got about 10 for partnerships, 10 for subchapter S. Okay, so we've got this subchapter S election to be valid for the current year. A Form 2553 must be filed. And remember, they'll let us file it what? For the prior year if we file it by the third month, 15th day of the third month. Okay, so before the 15th day of the third month of the current fiscal year, or what? In the prior fiscal year, then we can have it valid for the current year. Okay, number 12. Alabaster Company is a subchapter S corporation. It properly reported net income of $250,000 for financial statement purposes. And then it tells us it had net capital gains of 60, charitable contributions of 20. What is the ordinary business income loss that were reported to the shareholders on their K1? And so remember, when we look at this $250,000, that was taking all legitimate business deductions into consideration, capital gain, losses, whatever. It's sort of like their net income number, right? And so you sort of have to think backwards with these, and that what? If we had a capital gain, since that's something that is going to be distributed separately, reported separately, to get to the corporation's income, we would have to do what? Subtract out the gain. And since it's charitable, I can't talk today. Since a charitable contribution is what? Is a deduction for our income purposes, since we're going to report that one separately to the shareholders of the S corporation, we have to do what? We have to add back that 20,000. Okay, and we end up with the 210,000 answer to this question. Okay, so you got to think backwards about those things. What are legitimate, business deductions for calculating the net income of a corporation, like on their 1120, although it's an 1120S. But then you have to add back the things that would be reported separately, and that's what gets reported on the K1 for income from the corporation to the shareholders. Number 13, which statement is incorrect with respect to S shareholders' consent? And both husband and wife must consent. Yes, even though they are treated as what? Potentially treated as one owner, both have to consent. And S election requires a consent form from, I don't know what they put in my iced coffee today, but I'm having a problem here. An S election requires consent from all of the S corporation shareholders, yes, and it has to be in writing, okay? And so none of the above statements is incorrect. Okay, Black Company, an S chapter, get it out of my system here. I hope I'm not having a stroke over here. Okay, so Black Company is no wonder. A subchapter, okay, A subchapter S corporation. It reported book income of $100,000. Included in that amount is dividend income of $5,000, a net capital loss of $4,000, and charitable contribution of $20, determine the ordinary income loss and the nature and the amount of any separately stated items. I did the, for these, I did the free response questions. They're kind of mixed in with the multiple choice as opposed to just being at the end like they will on your test, okay? But, so let's just take a look at the answer here. And ordinary income is going to be the 100,000, but you got to think backwards. Since the dividend, even though that would be a good income item to the corporation, since it's going to be separately reported, we subtract it out, right? So we subtract out the 5. The capital loss, it's a legitimate loss to the corporation, but since we're going to distribute that separately to the shareholders, we add the loss back, right? And then the charitable contributions, like we saw before, get added back. So the ordinary income is 119, and then, as I was just stating, as I was walking you through those, the dividend is separately stated, the capital loss is separately stated, and the contribution of $20,000 is separately stated. Okay, number 15. I think, again, is one of those free response ones that I just kind of threw here in the middle. Okay, guys, if we're going to just go ahead and you want to just call, I mean, I've got no real desire to sit here and read off these questions to you, so I'm happy to stop whenever you are. Is there a question? Yeah. Mm-hmm.
Does that mean all of them are correct?
Yes.
So that's incorrect.
Which statement is incorrect with respect to the S corporations? None of the above statements are incorrect. Yeah, I mean, I guess if you wanted to look at it that way, you could ask me that on the test if something like that comes up. I don't know what you want me to do about that. A, B, C are all correct. None of the above statements is incorrect, so D is correct, but then that would make it none of the above statements is incorrect. Which statement is incorrect? None of the above statements are incorrect. So none of the above statements are incorrect. None of the above statements are incorrect, so which statement is incorrect? So none of them are incorrect? So they probably should have said that all of the above statements are correct? I don't know. Whatever. Bother your friends with that one. I don't care. Okay, if you have a question on that in the test, just ask me. Hey, if you think God comes down and writes these questions for the test bag, think again. Okay, so obviously there's some imperfection in these. Okay, but let's look at, is that what the question was? Okay. So let's take a look at 15, and they want the non-separately computed income here, which is very similar to what we've been talking about here for the partnership. So you've got the sales, we'll bring that down. You've got the depreciation recapture. And remember, guys, a good one for this is that one slide. Remember, I was making fun of the corporate veil, that little thing they put there, and there were things that were above that corporate veil and things that were below. Okay, so that's really how you would answer this. Depreciation recapture was above that. Then what? The cost of goods sold, and I have no idea who told them to write things exactly like this, but that's fine. You've got the cost of goods sold. The administrative expenses, where are they? Okay, those come down. The what? Depreciation expense, yes, that comes down. Okay? The rest of these things, which are going to be what? The things we didn't look at. Tax-free interest, okay, is something that's considered a separately reported item. The capital gain, the charitable contributions, I guess, being the other one. Okay, these are all going to be separate items. Okay, is there something entertaining about watching me read the questions? I'm not quite sure why we're doing this. I mean, I'm sitting here reading the questions and everybody's off in their own little other discussion or something. Are you getting anything out of this? Okay. I'm sitting there reading you the answer, so I'm just trying to figure it out. But, okay. Number 16, at the beginning of the year, clamp it. And this, from this test bank, somebody had a fetish for old TV series from the 60s. So at the beginning of the year, Clampett Inc. had $100,000 in its AAA. Now remember, we have the AAA, and we start with the beginning balance, whatever it is, and then any ordinary income items get added back to that, minus any distributions that might have gone. Okay, so they tell us that they had an AAA of $100,000 and $60,000 of earnings and profits. And during the year, they earned $50,000 of ordinary income and paid $200,000 of distributions. Assume that JD owns 25% of Clampett. His basis in Clampett Inc. at the beginning of the year is $30, and his share of the distribution was $50. How much of any of the distribution is going to be taxable as a dividend? So you first have to figure out, well, okay, how much does he have here? And he's got what? He's got $30,000 to start with, right? Okay, because we have to figure out how much of this is going to be considered a payout of a dividend that would be taxable to him. So then we've got the what? We've got the amount that's being distributed to the corporation here. So we've got $200,000, and the first $150,000 is distributed from the AA account, and so the remaining what? $50,000 is distributed from the C corporation. Okay, so we got this 150. I had 100,000 in there at the beginning. And then we had earned what? Another 50,000. So that brought it up to what? 150. Okay, and then when you take the distribution of 200,000, that first 150 is considered return of capital in a sense that they would have already paid tax at the shareholder level on that stuff, right? Whatever the A was in the AAA plus this year's amount of income, all of that's going to be distributed to the shareholders individually, right? So you're left with 50,000, and that is considered a what? A distribution of the C corporation money, which is considered a dividend income to him. So he has to get what? 25% of that? So the 50,000 times 25% is going to give him, what's that? 12,500. Okay, so 12,500. That adds on to the 12,500. That's his share of this dividend, and then of course, whatever share of the 150,000 he gets, which is the 30,000, I think, 25% of the 150,000. So his share is going to be the 12,500, right? Is taxable as a dividend. I'm answering a different question. What they're asking us, 12,500 is what's his share of the dividend? Okay, and that is the amount that's considered from the previous years of the corporation, the C corporation years. Okay, 17. At the beginning of the year, blah blah, same facts. And now they want his basis, what? After these transactions, which is sort of what I started answering there a minute ago. So it's his beginning is what? Of his share is 30,000. And then the additional 12,500 that we just took. And so the AAA is now going to be what? This 37,500? Huh? what am I doing here? What are they asking here? Oh, what is his basis in the stock afterwards, which is going to be, yeah, what is it, 42? Why am I having a problem here? What's the answer to this one? B? 5,000? Okay. So we've got original basis of 30 plus the 12.5 ordinary share of income. And then, minus the distributions. That's right. So it's 42. What is it? 42.5? Yeah. Minus the distributions that he's received, which is the 37.5 that he received, which is his share of the distribution. Okay. So that's where we get the 5,000. Okay. Number 18. In 2017, Kip invested $65,000 for a 30% interest in a partnership conducting passive activity. So now we're chapter what? I think this is chapter 11. Okay, so now we're getting into passive activity items. So in 2017, Kip invested $65,000 for a 65% interest in a partnership conducting passive activity. The partnership reported losses of $200,000 in 2017, $100,000 in 2018. Kip's share being $60,000 in 2017 and $30,000 in 2018. How much of these losses from the partnership can Kip deduct, assuming there are no investments and does not participate in the partnership operations? So what's happening here, have passive activity amounts here, and they want to know how much he can deduct. And we have a problem in that none of these losses are deductible, because you can't deduct passive activities against active income or portfolio income if you're an individual, right? Okay, so any answer that has a number in any year is incorrect, right? So none of the above is correct. Okay. Number 19, Josh has an investment in two passive activities. Activity A, acquired 3 years ago, produces income of $30,000 this year, while activity B, acquired 2 years ago, produces a loss of $50,000. What is the amount of the suspended loss? Now we can carry back and forward our passive activity losses. Okay, so what happens? Since he had, or carry forward our passive activity losses, so since he has a loss of has a loss this year of 30, or this one is income of 30, but he has losses of 50. So if we take the loss of 50, or you could look at the loss of 50, and he has 30 of income, then he's got he's got 20,000 that is suspended that he can carry forward and use against other losses in future years, right? Okay. Number 20, Carl, a physician. Did we have this question before? I don't know why this sounds familiar. I seem to remember Carl being in one of these questions. Okay, but maybe it's something different about Carl. But let's see. Carl, a physician, earns $200,000 from his medical practice in the current year. He receives $45,000 of dividend and interest during the year, as well as $5,000 of income from a passive activity. In addition, he incurs a loss of $50,000 from investment in a passive activity. So what's going to happen? That passive income is going to be is going to be wiped out by this passive loss. So we'll get rid of that entire $5,000 of income from the passive activity, because he has enough loss to zero that out. Okay, but that's it. He can't take any more of that, right? And so his income is the 45 plus the 200. 245. Okay. 21. Green Corporation earns active income of $50,000, receives $40,000 in dividends during the year. In addition, Green incurs losses of $70,000 from an investment in a passive activity acquired several years ago. And they want us to consider the following two statements. Green's current deduction for passive activity loss is $50,000 if it is a closely held C corporation that is not a personal service corporation. Now, first of all, the questions will tell you if it's closely held or if it's a personal service corporation, because the criteria is sort of nebulous about what exactly closely held means. It means they're not traded very often publicly, that sort of thing. Okay, so is it correct that Green's current deduction for passive activity loss is $50,000 if it is a closely held? And what? The answer to that one is yes, because if you're a closely held C corporation, you can do what? You can deduct passive losses against active. So that's really sort of almost a Chapter 18 question, even though it's here in Chapter 11. Okay, you can take it against active if you're a corporation. So that's yes. Green's current deduction for passive activity loss is 0 if it's a personal service corporation. That's also correct. Personal service corporations like CPA firms, that provide different services, dentist offices, that sort of thing. For them, the answer is what? The answer is no, they cannot. So that is also, they cannot take any activity losses. So that is also yes, isn't it? Okay. Okay, good. So that means the answer here is what? B? Oh, no. C, both statements? Okay. All right, good. Number 22. White corporation, a closely held personal service corporation, has $150,000 of passive activity losses, $120,000 of active business income, and $30,000 portfolio income. How much of the loss can they take? And this is really an extension of the last question. Answer is what? Nothing, because they're a personal service corporation, right? They are not. They're treated like individuals, essentially. Can only take it against passive losses can only be taken against passive income. Okay. All right. Good. In 2017, Emily invests $120,000 in a limited partnership that is not a passive activity. During 2017, her share of partnership loss is $90,000. In 2018, her share of partnership loss is $50,000. How much can she deduct in 2017 and 2018? Okay, so we have this what? We have these at-risk limits when it's not a passive activity. Okay, so in the first year, she can deduct what? The entire $90,000, because her at-risk amount is $120, right? And she hasn't exceeded that yet. And then when you get to year 2 and they have losses of $50, she is limited to what? $30,000, because that's all she had left of the at-risk amounts, right? Now, if she had done what? Invested more, then that would increase the at-risk amounts for her, right? But since she was holding there at that 120, and if I'm asking you, this was not a multiple choice question, if I'm asking you this as a free response question, I would have an expectation that you would give me those two numbers. Is the way we would answer that? Sort of like a fill in the blank in a way. I mean, I could say, give me this amount, give me that amount. Okay, but I'd be looking for those two numbers. Okay. All right, good. Let's look at another one. Again, sort of a free response one, 24. I didn't hit return here. 24. In 2016, Kelly earns a salary of $200,000 and invests $40,000 for a 20% interest in a partnership not subject to passive activity loss rule. So again, this is not a passive activity. Through the use of $800,000 of non-recourse financing, non-recourse means that they cannot come after her for her personal assets if once they've gone against the assets of the partnership, right? The partnership acquires assets worth $1 million. The activity produces a loss of $150, of which Kelly's share is $30. In 2017, Kelly's share of the loss from the partnership is $15,000. How much of the loss from the partnership can she deduct? Now she has what? She has an at-risk amount at the end of 2014 of $40,000, so she can deduct what? $30,000 of that entire share of her loss in the first year, right? Because her at-risk is 30. Carrying, therefore, what? This decreases the at-risk amount to $10,000. So when we get to that second year and there's what? This $15,000 loss, she can only deduct 10 of it because that's all she has left as at-risk amount. So you can carry it forward, right? Okay. All right, number 25, Sandra acquires passive activity 3 years ago. Until last year, the activity portfolio was profitable, and her at-risk amount is $300,000. Last year, the activity produced a loss of $100,000 in the current year, and last year, the activity produced a loss of $100,000. I'll learn to read one of these days. And in the current year, the loss is $50,000. Assuming Sandra has received no passive activity income in the current or prior years, her suspended passive activity loss from the activity is what? And we would have to limit it to her at-risk amounts, right? And so she would be able to take the full $50,000. Where's my answer here? The full, not $50,000, but the full what? $100,000 from the first year and the full $50,000 from the current year. Again, she has not exceeded her at-risk amounts. Okay. Number 26. Several years ago. Okay. Oh, so now we're chapter what? 12. Talking about credits. Okay. And this one you can see is going to be the rehabilitation credit. Rehabilitation credit is what? Is going to be 10% if the building is built before, what year is it? 1936. Okay. And then if it's a certified historical site or something, it's 20%. Don't worry, I'm not going to test you on the years. Okay. So I'll put something in there on the test that'll make it clear that it's qualified for one of those.
I have a question about because there's like a huge list of refundable and non-refundable credits, but we have only seen some. So in the exam, we are expected to know only the.
No, I would worry about the particular ones that we talked about because there was a ton of like or general business credits. Yeah. Okay, and so we won't get into those. I think the one we might get into is this rehabilitation credit, the right to work or whatever it is credit, the Job Act credit, and maybe the child deduction one. Okay, so we'll just deal with a few of them, just those three.
Yeah. The thing is that in the homework, there are a lot of questions from the other credits, so I didn't know if we need to know them or not. And yesterday you had the IRS page and it's a lot of material.
Well, I go through the process of dispensing all of those homework questions, and I don't sit there and say, well, we talked about this one, not that one. So again, to answer your question for chapter 12, I think it's going to be pretty much those three I talked about. The only one we didn't put in here is the child care one because it's kind of like how many kids do you have times X. Okay.
So
Could you restate the second one? You said rehabilitation, childcare.
And this other one, which is called the
The right to work.
right, is that what they call it? Right to work? It's not right to work.
No, it's
Right to work means they can't lock you out of your business, your job, if you set them on strike, and you will still work. You want to cross the table.
if a small company gives opportunities for employees.
Work opportunity
work
tax
opportunity.
credit. Yeah, work opportunity tax credit. Right to work is what allows you to cross a picket line. So they can't say, hey, you can't come in here and work. You strike. They have to come in and let you work and pay you. Okay. All right. Number 20, what? 26. Okay. Several years ago, Tom purchased a structure for $300,000 that was placed in service in 1929. So again, I'll make it clear that it qualifies. I don't expect you to remember whatever the stupid year was. To you guys, that sounds like 1,000 years ago. I mean, it sounds like a long time ago to me. So 3.5 years ago, he incurred qualifying rehabilitation expenditures of $600,000 in the current year. Tom sold the property in a taxable transaction, and the period of time they have to hold it to fully qualify is what is it, 5 years? To fully qualify? There's a certain amount of years they have to hold it, and I forget. Now I'm forgetting what the years are. It's chapter what? Chapter 11? No, chapter 12. I forget the number of years now. I think it's 5 years. Just to kind of remember those rules. And again, you'd be able to look this up. I'm not going to give this to you in the test, but you'll have your slides with you. But I think it was... Why'd I open chapter 11? Is it 5 years? Huh? Next slide. No, but where they give me the number of years before.
The next one.
No, before you don't have to deal with this is 5 years, right? Holding period of 5 years, and then, yeah, you're right. The next slide then starts to phase in. Well, if you hold it for less than 5 years, what's the amount you have to recapture? Okay, so make sure you remember or have written down for the 5 years, and then make sure you bring this slide, which shows you the percentages. And so they're going to be what? They're 3 years or more, but less than 4 in this case, so you're going to have to recapture 40%. And maybe I should have done this before I even started to work these questions. And then 10% before 36, and if it's non-residential and residential, what? Certified historic structure, they let them take 20%, right? Okay, good. So you come over and take a look at the question now. And the question is, he spends what? He buys the structure, John purchased the structure for $300,000, placed in service in 1929, and then he spends what? $600,000 on the rehabilitation. Okay, and so since he's not a certified historical structure, but it was before 36, he would have taken what? 10% as a deduction. Okay, so that's where the 600,000 times the 10% is coming in. And then he has to recapture, though, what? 40% of that, because he was in that 40% category. So the recapture is the 24,000. Okay. Okay, good. 27. Cindy incurred qualifying rehabilitation expenditures of $500,000 on a certified historic structure. So we're going to take the what? 20% for her. Okay. And so the amount of the original credit is $100,000, and this is one of those where it's a free response. So I'd just be asking you for these two numbers. And then she has to recapture what? Since she is selling the building in whatever it is, more than 3 but less than 4, whatever the 40% category is, she goes ahead and she takes $40,000 she has to recapture. Okay. 28, Black Company. Question on that? Okay, 28, Black Company paid wages of $180,000, of which $40,000 was qualified wages for the work opportunity tax credit under the general tax rules. Black Company's deduction for wages for the year is, and what happens? You have to reduce your deduction for wages by the amount of the credit, right? Okay, and so what happens? They had 40,000 was qualifying, and the percentages, you can take a 40% tax credit for that. And so since they've taken a credit, they have to subtract that credit from their deductible wages, right? And so they go ahead and subtract that. So if they had 180,000, they're left with 164 that they can deduct as a legitimate business expense for wages. Okay, 29. And they had these employees, and they paid them $11,000 during 2017. Gary Corporation is using the work opportunity tax credit, and basically it's 40% of the first $6,000 per employee. So really, if you think about it, it's what, $2,400 per employee? Right? And so 2,400, and they have how many employees? 2 employees, so that's 4,800. You know, this same question in the test bank, if you see it, they were using 10% in the calculations, or not 10%, but the first 10,000, I think. And I don't know where they were getting that. Whoever it was smoking crack. I don't know. I looked everywhere for 10,000, and I didn't see it anywhere. So I don't know what the hell they were doing. Maybe at one time it was 10,000 or something, but in 2017 it's 6,000. Question? That's it. That's all I got. You guys, you squeeze me dry of any more questions. I don't have anything to give you for Friday. I'd have to be digging through I don't know what to find it. And then that'll take all the fun out of the midterm, out of the final. Maggie? Yeah, I think 17 and 18. Okay. I gave you some from these chapters just to throw them in there, but yeah, 17, 18 is going to be the free response will come from. I know I wrote it down, but tell me again, guys. 20 questions, right? Multiple choice questions, 5 old exam questions. Okay, probably easy stuff that's burned into your memory by now, or maybe it's been burned out of your memory with the new stuff. I don't know, but pretty easy stuff in the first 5 chapters. Remaining 15 will be from the new chapters, of which I'm thinking
10 from, I wrote it down, 10, 17, 18.
10 from 17, 18.
And the remaining 5 divided between the...
Okay.
Can you change it to 9 and 6? You said 9 from 17, 18.
Let me write this down.
And then 6 from the other 4.
Okay, hang on. Let's write it down. And what I'm going to do is I'm going to write it on the screen, and I'll put this up too. So let's just do that. Let's put this at the top of here. I know I wrote it down a couple times, but I say something new every time, right? So let's just write it down. Okay, so on the exam, we're going to have midterm 1, midterm 2 questions, total we said of 5, right? Okay, and then let's just go in order. Chapter 11, chapter 12. What do you like better, 11 or 12? 11. So 3 from chapter 11 and 2 from chapter 12? Okay, and then we've got what, 17 and 18? And you said what?
What about chapter 21?
Well, okay, I was writing them in order, but if you don't want to go in order, I'm not one to argue. Okay, 21 and 22, you want what?
Oh, from what you said previously, you said 6 multiple choice were going to be from 11, 12, 21, and 22. And then the rest, 9, would be from chapter
Oh, I
17,
see.
18.
Okay, so if that's the case, then it's 1, 1, 2, 2? Like that? I mean, if you ask me, the chapter 11 and 12 questions are easier.
I think the 11 is easier.
So you want to do 2, 2, 1, 1?
Yeah.
Right? 11 and 12 questions are easier than 21 and 22, and you start getting into what's the separately items, what's the together items, you know. Okay, so 2, 2, 1, 1. And then that leaves us what? 6 out of 15, and you want, huh? Well, we've got 15 here. That's 2, 4. That's 6. I got 9 left.
So 4 each, and then 1 free response from either.
I thought it was going to be 20 multiple choice and 1 free
You
response.
can just choose like between 17 and 18. Which one
Okay. So since it's 15, I'll just put an even number of each. Okay, so I'll just do. I'll do it this way. I'll do 7. I'll do 8 of these and 7 of these, because a lot of those.
It needs to be 10, bro.
Huh?
It needs to be 9.
Oh, 9. Oh, okay. So I'll do 4 and 5. Okay.
Also 3 responses.
And 1 free response from chapter. Well, I'm not going to go that far because I don't know yet. I have to see the question. And once I see a question, I might fall in love with it. So it's 17 or 18. I don't know yet. Because once I see a free response question, you know, like I might see a nice, cool dividends received deduction question. I think that looks to me like a good free response area. Dividends received. That might be a good question to do a free response, because you have to do you have to take the amounts, but if it generates a loss, then you have the limitations, but if it generates a loss, then you can take the full amount, all that stuff. Dividends received deduction might be a good free response question if I can find one. Assuming I can find one, dividend received deduction might be a good one. I can save this. Okay, guys, I guess that's pretty much it. Next time I see you, it will be for the midterm, final, which is on Thursday, a week from, not next week, but the week after, Thursday the 10th, 3 to 6. So, you know, make sure you're on time. It's the whole class period. I'll see you for that, and we'll wrap this puppy up. Okay?
Is it in here? Is it in this location?
To my understanding, I didn't see that it was moved at all. There was nothing that showed us up on the list of moving. Yeah, it said here. It was in this, whatever this. It was the same room. Yeah. On that list they sent out. Okay? All right, guys. See ya. Good luck. Study hard.